Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of the confusing world of corporate filings by looking at the numbers and the stories they tell. Today we are diving into Miluna Acquisition Corp's annual report, and let me tell you, it is a snapshot of a company in a very specific part of its journey. Think of it like the introduction to a new business venture, all about getting ready for a big move. This is a pretty standard filing for a company going public through what we call a SPAC, or a special purpose acquisition company. Basically, it is a company formed with the sole purpose of raising money through an IPO, an initial public offering, to then find another already existing company to combine with Miluna Acquisition Corp. Is in that initial phase, preparing to make its big business combination. So, what is the big news in this report? Well, it's all about how Miluna raised money to get off the ground. On the 24th of October 2025, they had their IPO and sold 6 million units. Each unit was a package deal, one ordinary share and one redeemable warrant at $10 each. That brought in a cool $60 million. They also had a private placement with their sponsor, Miluna Technology Limited, selling them almost 200,000 more units for about $2 million. And just when you think it is over, the underwriters exercised their option to buy even more units, bringing the total raise to a staggering $69 million from the IPO and related deals. Now, where did all that money go? A huge chunk of it, $69 million, went straight into a trust account. This is standard SPAC practice. That money isn't just sitting there idly. It is invested in safe, short-term US government treasury bills or money market funds. This trust account is essentially the war chest ready to fund the future business combination. Let's peek at the balance sheet. As of the 31st of December 2025, Miluna had a total of over $70 million in assets. The biggest chunk, almost $70 million, is that cash and marketable securities held in the trust account. That is the lion's share. On the other side, you have liabilities, mainly deferred underwriting fees totaling $690,000. Then there is the shareholders' equity, which is pretty small at just over $11,000. This makes sense because most of the shares, almost 7 million of them, are classified as ordinary shares subject to possible redemption. What that means is, if Miluna does not find and complete a business combination, these shares will be redeemed and the money will go back to the shareholders. This is why they are considered temporary equity, not permanent. Looking at the statement of operations for the period from their inception in June 2025 through the 31st of December 2025, tells us they are not running a typical business yet. They had formation and operating costs of about $155,000. But here is the interesting part: they earned over $471,000 in interest income from their trust account. So, while they were busy setting things up and looking for a business to buy, their money was earning them a nice little return, resulting in a net income of over $316,000 for that period. Even with that net income, the earnings per S-share for both redeemable and non-redeemable shares are just $0.07. This is because they have a lot of shares outstanding, almost 7 million redeemable ones, and close to 2 million non-redeemable ones. The key takeaway here is that the income is mainly from interest on their parked cash, not from actual business operations. Let's talk about the team. Miluna has a board of directors and executive officers. Hao Yan is the chief executive officer and director, and Daniel Albert Mace is the chief financial officer and director. They've got a few independent directors too: Lu Huanzhong, Yating Li, and Mei Qi TSI. These folks are tasked with steering the company towards its business combination goal. The report details their backgrounds, showing experience in finance, venture capital, and other business areas. Now, with any SPAC, especially one where management and directors also have connections to other similar ventures, conflicts of interest can arise. The report is very clear about this. It spells out the directors' fiduciary duties, but also acknowledges that they might have obligations to other companies. For example, some directors and officers also serve similar roles for another SPAC called Bololock Acquisition Corporation. This means if they find a good business opportunity, they might have to offer it to that other company first. They are basically saying, hey, we have other commitments, so opportunities might not always come our way. As with any company, especially one that has yet to complete its core mission, there are risks. The report highlights that their success entirely depends on finding and completing a business combination. If they fail to do so within a certain time frame, usually around 18 to 21 months, they will have to liquidate and return the money in the trust account to their shareholders. This is a common risk for SPACs. They also point out the lack of business diversification, as their future performance will likely hinge on the success of a single target company. Looking at the use of proceeds section, it is clear that the vast majority of the IPO money is in that trust account earmarked for the business combination. They have some cash outside the trust for operating expenses, but the real firepower is in the trust. The sponsor and management can loan the company more money if needed for working capital. and these loans can sometimes be converted into private units. So, what is the big picture here for Miluna Acquisition Corp? This is a company in its formative stages. Its financial statements show a company with a significant amount of money raised, mostly parked safely in a trust account, waiting to be deployed. They have not generated revenue from operations because they are not operating a business yet. Their income comes from interest on their parked cash. The primary goal is to find a suitable business to acquire. The risks are apparent. If they don't find a deal, the money goes back to investors. The leadership team appears experienced, but the potential for conflicts of interest due to their other affiliations is a factor to watch for investors. This type of filing is less about current business performance and more about potential. It is a bet on the management team's ability to identify and execute a successful merger. The strategy is straightforward: use the IPO funds to acquire a promising business. Nothing more, nothing less at this stage. Alright? That is our breakdown of Miluna Acquisition Corp's latest filing. What is your take on SPACs and companies like this in their early stages? Do you see the opportunity or the risk? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps the channel a lot, and make sure you subscribe for more deep dives into corporate filings. And hey, if you want to connect with other finance enthusiasts and discuss these reports in more detail, check out our Discord community linked in the description. Thanks for watching, and we'll see you in the next video.